The nation that rebuilt its enemy after World War II ended up smashing its products with sledgehammers out of pure financial terror. The panic of a wounded superpower boiled down to a cheap consumer appliance. July 1987. The immaculate lawn in front of the Capitol in Washington. 9 U.S. congressmen, surrounded by photographers and reporters, raised heavy steel mallets. With perfectly choreographed fury, they repeatedly struck a Toshiba portable radio, reducing it to a mess of crushed plastic and broken wires. Welcome to Plexo. The hammer spectacle wasn't just a political tantrum. It was the visceral symptom of a collective hysteria consuming America. During the 1980s, the country that invented consumer capitalism felt it was losing its own game in humiliating fashion. Japan, an island nation with no natural resources, was devouring global markets with relentless technological efficiency and unbeatable prices. The official excuse for destroying the radio was that a Toshiba subsidiary had sold milling technology to the Soviet Union. The real reason cut much deeper into national pride. The U.S. trade deficit with Japan had exploded out of control, approaching $50 billion a year. American factories were closing by the thousands, while California's ports flooded with high-quality Japanese televisions, microchips, and cars. Washington politicians, unable to compete on innovation or efficiency, turned to the oldest weapon of declining empires, savage protectionism. It became the only quick fix to calm unemployed voters. The U.S. government began blaming Tokyo for its own industrial failures, setting the stage for a monumental economic clash. The irony is that every protectionist measure Washington adopted would unknowingly finance the next phase of Japan's advance. Japan's economic invasion didn't start in the skyscrapers of Wall Street. It began on the cold streets of industrial cities like Detroit. The global oil crisis had changed the rules, and American consumers demanded cars that didn't guzzle gallons of gas. Toyota and Honda offered exactly that, triggering absolute panic in Michigan boardrooms. Lee Iacocca, the legendary CEO of Chrysler, became the media face of this corporate fury. With a stern look, tailored suits, and a cigar always clenched between his teeth, Iacocca used national TV to accuse Japan of destructive trade practices. His aggressive, nationalist rhetoric fueled a hatred that soon jumped from corporate offices to suburban streets. At fundraisers in Michigan, unemployed auto workers paid $1 for the privilege of beating a Toyota Corolla with a baseball bat. They smashed windshields and dented doors in a brutal ritual of physical desperation, looking for someone to blame for their misery. In 1981, under immense political pressure, the U.S. forced Japan to sign a voluntary export restraint agreement. The deal strictly limited how many cars the Japanese could ship to the American market each year. It seemed like a brilliant victory for Iacocca. But it turned out to be a monumental miscalculation. Unable to sell more volume, Japanese automakers simply changed strategy. They stopped exporting cheap compact cars and started shipping high-margin luxury models, creating premium brands like Lexus and Acura. They made much more money, selling fewer units. Far from saving the American auto industry, Washington's protectionism only financed the deadliest evolution of its rivals. The very restriction designed to drown them taught them to breathe deeper. By 1985, President Ronald Reagan's administration realized that tariffs and import quotas weren't stopping Japan's relentless advance. Tokyo's real edge was in the currency markets. The US dollar was artificially strong, making American exports brutally expensive and Japanese goods cheap. They had to crush the dollar's value at any cost. On September 22, 1985, finance ministers from the world's 5 biggest powers met in secret at the luxurious Plaza Hotel in New York. There, among crystal chandeliers and mahogany walls, the US, Japan, West Germany, France, and the UK signed the historic Plaza Accord. The physical act was subtle but devastating. With the simple stroke of fountain pens on linen paper, the financial leaders agreed to massively intervene in global markets to force the dollar down. The next day, Wall Street tickers flashed red as the greenback plunged out of control. For Japan, the consequences were seismic. Within 2 years, the yen's value doubled against the dollar, from 240 to just 120 yen per dollar. Japanese exports became twice as expensive on international markets, crushing their industrial competitiveness. Washington celebrated the move as a masterstroke of modern financial diplomacy. They had bent their biggest trade rival to their will, using exchange rates as a silent weapon of mass destruction. No one in the White House knew it then, but they had just handed Tokyo the exact fuel it needed to buy up America. The Plaza Accord succeeded in making Japanese exports more expensive, but it triggered a truly terrifying side effect. With the yen's value doubling, Japanese purchasing power abroad multiplied overnight. Suddenly, everything in America seemed to be on sale, and Tokyo had pockets stuffed with cheap money. To offset the export hit, the Bank of Japan slashed interest rates, flooding its own economy with easy, unrestricted credit. This perfect storm of liquidity unleashed the biggest asset bubble in modern history. Land prices in Tokyo soared so high that at their peak, the grounds of the Imperial Palace were worth more than all of California. Armed with this phantom wealth, Japanese corporations crossed the Pacific to buy up the trophies of American capitalism. In September 1989, Sony shelled out $3.4 billion in cash for Columbia Pictures, grabbing a piece of Hollywood's soul. The ultimate national humiliation came a month later, in October 1989. Mitsubishi Estate bought a controlling stake in the Rockefeller Center itself. The image of dark-suited Japanese executives strolling across the iconic ice rink, as its new absolute owners sent a wave of panic across the country. American magazine covers screamed that Japan was buying America piece by piece. Washington's protectionism, designed to save manufacturing, had ended up handing the nation's real estate and cultural jewels to its biggest rival. The trade war, at that moment, seemed completely lost. The dazzling financial empire Japan built on the ashes of the Plaza Accord was literally made of paper. The asset bubble had grown to defy all economic logic, propped up only by extreme real estate speculation and runaway credit. In late 1989, the Bank of Japan, terrified by rising inflation, decided to raise interest rates to cool its overheated economy. That was the fatal prick. In January 1990, the Japanese stock market began a free fall, from which it would take more than 3 decades to recover. The disaster played out in Tokyo's frantic trading floors, screens flashing blood red, as $2 trillion in national wealth evaporated into the cold winter air. Japanese companies, suddenly drowning in unpayable debt, stopped buying U.S. assets and started selling them at massive losses. Mitsubishi eventually abandoned Rockefeller Center, and Japan's economy sank into what is now known as the Lost Decade, a long period of secular stagnation, crippling deflation, and zombie companies that halted the Asian miracle forever. While Japan languished, the United States surged back in the 1990s. Riding the emerging internet revolution and software development, Silicon Valley corporations reclaimed the global throne that Detroit's old factories had lost. The fear of a Japanese takeover vanished as quickly as it had appeared. America didn't win the trade war, it just got lucky that its enemy committed suicide with the weapons Washington sold it.